What does this mean? Pakistan is a nuclear-armed nation with over 165 warheads from short to medium range. The country also has ongoing border disputes with India and a strong military ties to China. A destabilization of the region could lead to a much larger geopolitical crisis, as well as send shockwaves through the global economy. An IMF refusal at this time could trigger chaos that reverberates to the east and the west. Again, not everything that matters happens in the United States or the Western nations. Pakistan is a little bit on fire if the IMF doesn't help to stabilize that whole region. Hey everyone, this is Rob Kientz with GoldSilverPros.com for this week's weekly market wrap-up. And the title of today's presentation is The Middle East is Starting to Get Interesting. I'll have stories for you today on Iran, Iraq, and a new trade deal that they're working on, as well as what's going on in Pakistan as that economy starts to melt down and the IMF basically threatening to cut them off, which is not really good there. And I think that's going to play into worldwide trade, supply and demand, as well as a geopolitical realignment that we want to keep an eye on because of trade agreements and therefore monetary flows between nations. It will affect what goes on in the U.S. as well as around the rest of the world. We're reporting this on May 12, 2023. It's 1:20 p.m. Central Time as I'm recording this. So please take that into account when we're discussing prices. We're going to talk first about what's going on in the gold market. As I look at goldprice.org, gold is trading at $2014.96, down $1.33, basically even on the day, give or take. $23.98 in silver, down 18 cents. We've fallen below critical support on silver. We're still above critical support on gold. Critical support on gold, I would put it around 2,000. Of course, 1,900, the previous all-time high, but 2,000 is also a good support level. The critical support level that was breached to the downside, silver, it's at $23.98. $24.50 is really the one we want to stay above. I did warn on the blog and JM Bullion this week in my gold price analysis that I thought gold and silver could range trade or even fall back some here into a consolidation phase, although I think the long-term bull market is in place. And the reasoning for that is probably stronger than it's ever been. But traders will, when the market gets a little frothy, they'll sell off. And I think with gold and silver doing so strongly, a lot of the short interest in gold and silver from the bullion banks needs to be converted to long interest. So I expect some short selling to occur, as well as rolling over into future futures contracts months. And so I expect some softened gold and silver, but I expect there to be more economic catalysts coming faster and faster, which will overall keep that gold and silver price above and keep it rising over time, even though we're going to have some healthy pullbacks along the way. And at the end of this week, we're getting a little baby pullback, not too much, but it has come off a little bit. And again, that's normal when you're talking about the derivative markets, which is where spot price is determined. Looking at what's going on in the economy, not a whole lot of really just hit you in the face data this week. We did have the CPI print this week. The government's inflation print is at 4.9% on expectations of 5%. That has come down from the near double digits we had basically earlier this year and really last year. Last year was a big inflation year. I think we're going into a temporary deflation cycle. You can see that in the data as the economy starts to head toward a recession. At some point, we'll be in a recession and inflation will continue to go up again. That'll be stagflation. That will happen eventually, though. I think we're going to go through a deflationary period first, and we're going to watch it and show you what happens. We are not out of the woods by the fact that CPI is going down. CPI is like one of those warning lights on your dashboard when it's going up, but just because that number is going down doesn't mean it's the only warning light. It tends to go in cycles until it goes to its blow off and then everything crashes down. So I think we're in that lull period, the eye of the hurricane, if you will, before we get that next big bout of inflation. And so we can enjoy that and some consumer products that aren't going to rise quite as much. It'll be a little bit of relief for people's checkbooks. Producer price index up 0.2%, under 0.3%, but higher than last month. Last month, the producers paid 0.4% less than they did the month previous. This month, they're paying 0.2% more. So the PPI has gone up a bit, which indicates CPI will probably go up as well because the producers are going to pass their costs on to who? The consumers, in the form of higher retail prices. There's also indication in the economy stories I'm reading this week and last week that the consumers tapped out and that they can no longer pay the prices that they have. So I think what you're going to expect retailers to do is start cutting sizes down in order to keep those prices even. So if you're in a 10-ounce jar of peanut butter for $2.59, whatever that is, making up prices, in a month it may be 8 ounces for $2.59. Okay, and I think that's what's going to happen. We're going to see a little bit more shrinkflation in prices. Initial jobless claims came in at 264,000. That is higher than expectation of 245,000. I've said that the government numbers on unemployment are not correct. Going over downward revisions, you'll see that in the blog reports that I write for JM Bullion, as well as on our channel Gold Silver Pros. And initial jobless claims has spiked up. That tells me that there are more jobless people out there than are reflected in the government's numbers, and the government really needs to go back and re-revise those. I'll continue to report on that so you're aware. Continuous jobless claims are coming in higher at 1.81 million. Persistently, we're having near 2 million continuous jobless claims. That's not an outstanding number to be concerned about, but the fact that that's persistent means that unemployment's not improving the way the government indicated. Consumer sentiment is down. It's got a 57.7 print on that indicator. It was a 63.5, and we saw it last year at much, much higher than that around holiday season. I did mention around holiday season that number would come down as we got into first and second quarter. A lot of financial data came out, and we started to see the consumer not having money to buy things or tapped out. And we're seeing that in the numbers in consumer sentiment. All right, going to the markets. The Dow, the S&P, NASDAQ, and Russell are all down between 0.57 and 0.94%. I'm not going to read the numbers because they're just down a little bit. The stock markets are struggling, and they're struggling basically on relatively weak earnings reports and just continued concerns about the banking sector, which I think people have figured out. We're not out of the woods on bank failures. We just have a little bit of a respite, and there's still some worry in the market. So you see some sideways trading on the stock markets. Looking at the treasuries, the bonds, the 1 month has spiked up. It's up 0.12 today to 5.667. Okay, again, the short-term treasuries are telling us there's a lot of risk in the market, and people are expecting a recession coming any time. That's why interest rates are higher and elevated on the shorter term treasury issuances, because for people to take short-term paper, they see a lot of risk. They want more return. When those interest rates rise, it's an indication of risk. Everything behind the 10-year, including the 7, the 5, the 3, the 2, the 1, the 6-month, 4-month, 3-month, 2-month, and 1 month, is in yield curve inversion with the benchmark 10-year. What does that mean? When anything shorter than the 10-year is commanding a higher interest rate than the 10-year, it sees people are saying, I see more risk now, give me more return. The benchmark one that indicates oncoming recession is the difference between the 10-year and the 2-year. The 10-year right now is at 3.448. The 2 years at 4.834. That's a yield curve inversion. 2 years is requiring much more of an interest rate. Therefore, the bond market participants are predicting a recession. That's been flashing a recession now for 5 or 6 months. It's not going away. So despite what the government says, the smartest market traders are telling you a recession is coming. You can see it in the bond market. Crypto took it on the chin this week. Today, Bitcoin's down $534 to 26,340. Not doing so well. Bitcoin Cash 114.03, actually up $1.73. Ethereum is down 1381 to 1772.48. So you're seeing a sell-off not only in the equity markets, but in the crypto markets as well. For big stories this week, I promised you a couple from the Middle East. The first one is from The Cradle, which is an independent news agency, reporting that Iran and Iraq have signed an agreement for expanded energy ties despite U.S. sanctions. So it appears as though the U.S. strategy towards the Middle East is backfiring and former foes are coming together. First, it was Iran and Saudi Arabia, and now it's Iran and Iraq are becoming trade partners. A lot of this has to do with the influence of China and Russia in the region and their Belt and Road Initiative, but also it has to do with the fact that former allies and enemies of the U.S. in the Middle East are now teaming up together, despite the fact that that's not what the U.S. wants. And you're continuing to see de-dollarization, alternative trade, and political and cultural agreements with these nation states that used to be on the opposite sides of each other and part of the overall U.S. strategy in the Middle East. They're starting to come together, not including the U.S. Again, I'm going to continue to emphasize the fact that people are throwing off the U.S. dollar. They're throwing off the U.S. in terms of trade partners, saying we can do this ourselves. The rest of the world is building their own trade and currency systems, and we're going to continue to talk about it as long as it happens. A quote from the article: the energy agreement was signed between OG and Iraq Oil Minister Hayyan Abdul Ghani. The meeting between Sadani, OG, and Abdul Ghani resulted in an agreement to establish committees to discuss the development of joint fields under international agreements and cooperation and refining what? Petrochemicals, as well as oil exploration and infrastructure development. An Iraq oil ministry statement reads, according to this article, the Iranian oil minister expressed the country's desire to expand the horizons of cooperation in the implementation of joint projects in oil and gas sectors, projects for the construction and development of oil refineries, the expansion of oil and gas pipelines, and environmental cleanup. Notice they're not involving the U.S. or Western companies in this. Former foes are getting together doing energy agreements. Big news. Second story comes from Pakistan. Pakistan may lose support from the IMF, risks debt default as civil unrest continues. Pakistan is in the middle of civil unrest due to dissatisfaction with the people over country policies and the fact that they're going through a big financial situation. The rest of the world, and the reason I bring you these stories is the rest of the world is not as in good a shape as we are financially, and this could portend what's coming to the U.S. That's why I talk about it. A quote from the article, we consider that Pakistan will meet its external payments for the remainder of the fiscal year ending in June, says Grace Lim, a sovereign analyst with Moody's in Singapore. However, she says, Pakistan's financing options beyond June are highly uncertain. Without an IMF program, Pakistan could default in given its very weak reserves. The reason, and this is not a quote, but reading from the article, the reason for the IMF pullback is obvious. Mass civil unrest has exploded in response to the arrest of former Prime Minister Imran Khan on corruption charges. Pakistan's Supreme Court has ruled that Khan's dramatic arrest this week was illegal and has ordered his immediate release. His lawyers had argued that his detention from court premises in Islamabad on Tuesday was unlawful. What does this mean? Pakistan is a nuclear-armed nation with over 165 warheads from short to medium range. The country also has ongoing border disputes with India and a strong military ties to China. A destabilization of the region could lead to a much larger geopolitical crisis, as well as send shockwaves through the global economy. An IMF refusal at this time could trigger chaos that reverberates to the east and the west. Again, not everything that matters happens in the United States or the Western nations. Pakistan is a little bit on fire. If the IMF doesn't help to stabilize, that whole region could be plunged into uncertainty at a time when we don't need that in the world economy. And again, the economic problems the world is seeing are not limited to Western nations or China. It's all over the world, and that's why we report on it. All right, next we're going to do the gold and silver report. We're going to bring you what you guys really come here to see, is my view on the gold and silver markets, given all of the economic data and the geopolitical stuff we just talked about. You can see here on the gold chart on CME Group, we've had elevated gold trading throughout the month of May. They're getting frothy in the gold market in May. According to Thursday's data, we had 2975 contracts, 2,975 EFP over to the London market. And on Wednesday, we had 3,863 EFP over to the London market. And on Tuesday, we had 1,536. And on Monday, 223. So this week, we've had a lot, probably close to 8,000 to 9,000 contracts moving from the COMEX to London. Why? Because as you look at the data, May, even though it's a tradable month, is not a big contract month, only 208 open contracts, and we're only 12 days in. The next big tradable month is June. And as you can see, 29,000 contracts rolling from June, a lot of it to August. So August is quickly becoming the next big month. And then the next big one after that will be December. That's how the futures market rolls. So you see a lot of contract rolling. That's put downward pressure on gold. But there is healthy demand. And because you can't get a lot of current deliveries in May because there's not a lot of contracts, you see only 208 contracts. You can only deliver 208. If those 208 wanted to deliver, they have to want to deliver on both the buy and sell side. So because there's not enough and people are still demanding gold, they're going to get it from London and they're pushing it back to June. But that's okay. They want the gold. What about the settlement data? Looking at Friday's data as of 1 p.m. Central Time is about 30 minutes old. Gold is trading down on the dominant contract month of June, 70 cents. And on the next dominant contract month of August, 80 cents. To close around 2019-80 in the June contract and 2013-910. In the August contract, gold is not in backwardation, which is a good sign depending on how you look at it. It means we're not in a shortage condition. Looks like a healthy trading market. Let's look over to silver. Silver, we've seen a little bit more frothy in May, not quite as much as gold, a little bit less of a battleground between longs and shorts, but you do see some volume. Looking at EFP, 1,864 moving over to London. Why? Because only 610 are open in May. May is not the dominant contract trading month for silver. July at this current time is, and people are still piling in. It looks like September may be setting up for the next one. And then December, those are the only ones left on the board after July. It looks like that we'll see all trading in silver for the rest of the year. 1864 EFP over to London. And I call that out because it talks about existing demand in precious metals and gold and silver being pulled forward out of the COMEX in the United States over to London. More demand than COMEX can handle given trade. Remember, only about 6 months in gold and silver every year are heavily traded. The rest are lightly traded. So if you want physical from that market, sometimes you got to go EFP it over to London. And of course, sometimes that's just price arbitrage as well. All right, that is Wednesday's data. Looks pretty good. Thursday's data, again, 1864. Wednesday's data, 293 EFPs. Overall, you can see a healthy amount of trading. Let's go over and look at the settlements where we get the prices. Again, Friday's data, 1:02 p.m. Central Time. About 30 minutes old as I record this, couple hours old as you'll see it when you see it. So it's trading down about 27 cents on the dominant contract month, which is July. How do we know that? Because of the volume, 67,000 contracts traded. That's the biggie. September and December will be the next ones. December will be the next big one, I predict. And that's why I see a lot of contracts there. Although a healthy amount of contracts still in September. If we look back, that's Friday's data up until now. If we look at Thursday's data as of close, gold down about 23 on trading of 107,000 contracts. Overall, yeah, a bit of a sideways trade, a little bit of weakness in gold silver market. I said it would probably happen. We're in consolidation. But more news will change that very quickly. We're looking at a longer term chart on actual gold flows. This chart is different. This is talking about gold flows into the COMEX and the ETFs, most of which are hosted in London, not all. And that's a little bit different than the futures. The futures is mostly paper. This is mostly physical, which is why I like this chart. Thank you, Mr. Nick Laird from Gold Charts R Us. On the COMEX, you can see net. Gold's been flowing in the last 4 weeks. We do a 4-week little indicator there. Not too bad. If we look at COMEX in total, we click there and we get the chart. Overall, little bit of gold coming into COMEX, but since silver squeeze, most of it's come out. That's ounces. Now, this value is going up because gold price is going up. That's value held. But if you look at the actual physical ounces, it's been down a little bit coming back in, but ain't nothing compared to last 2 years. All this gold flowing out. So don't let the green fool you. Most of it's flowing out, although with higher prices, you're seeing a bit come in. Now, if you want to know what is the chance that when gold goes to 2,100, 2,200, 2,300, that a bunch of it get dumped on the market and cause the price to fall. Well, you've seen some dumped here at higher prices, but it's not like people came in at 2,000, 30, 40, 50 gold and sold all of it. We got over 2,000 gold and you just had a little baby bit come back in. It's not been that much. So people are not giving up their gold at these prices. Are they giving up their silver? Let's see on the COMEX. Nope, still selling off the COMEX. This is total ounces held in the Western market in COMEX, and it's come down since silver squeeze and has not come back. You've seen a little bit of rise in terms of value, but that's prices. It ain't ounces. People aren't putting silver back into the market. Sorry, it ain't happening. The 4-week trend here, total on COMEX is down 3.5 million ounces. Total overall in COMEX in London down 4.5. People want their silver. Why is silver going off and a little bit of gold is coming back on? Why does gold have a green number and silver a red number? Because silver is mostly seen on the markets as an industrial commodity. It's back in vogue as money, but that demand is much lower than the industrial side. Therefore, most silver is going to get used in industry. Therefore, overall silver is going to continue to be pulled out regardless of the price because we just need it. We're about 200 million ounces short in mine production. That's an estimate and a guesstimate from Metals Focus and the Silver Institute over what we produce. And so that's why you see it coming off the exchanges. What about London? Well, we did finally get the April data. As you can tell, in March, we had 149 million troy ounces in London of silver of 846. So a little bit starting to flow off again. Why is it flowing off? Well, probably because we have these EFP prints of 1,864 from COMEX that's going from COMEX to London, and then we see it starting to come off. So some of that is physical delivery because you see physical coming off when it comes from COMEX. Now, those aren't one-to-one numbers. I don't have a ledger that says every one of those trades was physically delivered on London, but when you see the trades go over and you see the metal start to move out of London, you can say that some of that is from the American market. We just don't know how much. Gold overall about steady. So gold is holding steady. Looking at the Shanghai market, not much to report. I think I've already talked about this month. Which month are we talking about? The last month. And in Shanghai, lots are flowing off. You start to see these numbers turn around in terms of overall stock and flow, in terms of trading volume. And so you have a nice healthy set of deliveries. The biggest number to look at is delivery ratio. This is the total for the year. 76% of gold contracts have been physically delivered in Shanghai, 19.15 silver. In the current month, it's a little bit lower, 75.67 gold and 15. So nice healthy deliveries in Shanghai. Not anything really to write home about. So I'm not going to say that physical deliveries overseas are killing it. I think we've had people take their physical deliveries. A little bit of gold was sold back in the market, not really any silver. And that's why you're seeing gold and silver prices kind of just sit here going, no. It needs another big crisis. It needs another news event, and it will move again. Don't be surprised if gold trades down a little bit in the next week to 2 weeks, depending on the economic data we get and any bank failure news and geopolitical happenings. And pay attention to the Middle East, because it could be the Middle East is now a catalyst. Look at what's happened in Pakistan, the IMF. Look at what's happened in some of these agreements with Iran, Saudi Arabia, and Iraq. These are going to affect the gold market, and these will be buoys under the gold price, which is why I report on them. That's going to do it for this week's weekly market wrap-up. Thank you for tuning in to both Gold, Silver Pros and JM Bullion channels, where we do this every week, and it is one of our most popular segments because in about 10 to 20 minutes, we get you updated on everything going on, the major events going on in the market, and we prep you for next week. We'll do it every week. Thanks for stopping by. Come back again next week. This has been Rob Kientz with GoldSilverPros.com.